So I am very excited to be joined by some awesome investors today. We're gonna have you guys introduce yourselves in a second, but we're here to talk about if there are VC scale returns in protocol investing. I'm Spencer Noon. I'm head of crypto investments at TTC Capital. We're a stage agnostic crypto fund that's based in South Florida. Let's Kyle, let's start with you. Give us the quick and dirty on you, and we'll pass it to everyone else before we dive into some questions.
Sure. Hi, everyone. Thanks so much for attending. Excited to be here, even despite the virus. My name is Kyle Samani. I'm a co-founder and managing partner at an investment firm called Multipoint Capital. We run two funds, a hedge fund and a venture fund that we invest in all the way from seed stage all the way through Bitcoin and everything in between. Our investment mandate is crypto things broadly. We invest across three major theses: open finance, Web3, and non-sovereign money. And super excited to jump into a whole range of fun issues around crypto versus equity.
Panel was? I didn't realize. No one told me.
I don't know what this panel.
We were thinking
Steve, you go.
We'll probably talk about that.
Sorry, who's up next? Me?
Yeah.
Go ahead,
Okay.
Steve.
Hi, I'm Haseeb Qureshi. I'm managing partner at Dragonfly Capital. We're a global crypto venture fund. We invest in everything across the stack from DeFi to exchanges, equity, and crypto tokens. So I'm looking forward to this discussion.
Hi, my name is Lasse. I'm one of the founding partners of 1KX. We're an early stage token network fund. And what does that mean? It's very similar to Silicon Valley style sort of network venture capital investing, but we do so exclusively in open source token networks.
Very cool. Okay, so someone take a stab at defining what protocol investing is.
Maybe since we have token maximalist on the back of our t-shirts, I'll take the first stab. I think it sort of goes in line with the FET protocol thesis. Sort of we have an internet of information, and those protocols, HTTP, IPv6, etc., are very thin protocols, and they're word investable. And all the value of this of these internet accrued on the applications on top, namely Facebook, Google, Amazon, etc. And you can already see they're all on the west coast of the Americas. So it was really like in sort of Silicon Valley insiders game. Very selected circles that were able to sort of reap the massive rewards of this new internet, other than the economic benefit that it brought, but let's say from the investment perspective. And the idea is now with the FET protocol thesis that we're now building an internet of money, an internet of value. And the protocols that run this internet of money are actually quite complex and much fatter, but they're also investable. They have, a sort of a variety of tokens. I think the first token really was Bitcoin, right? It's essentially a payment token, a mining token, but it seems to work so far. And you basically get to invest in protocols of a new internet of value and sort of participate in the upside, whatever applications, win on top.
I feel like the FAT protocol thesis is kind of it's like the Magna Carta of what we do. It's sort of like the beginning document that kind of defines how people think now today about protocols. So I think it might be worth us kind of going through what sort of we think each of us individually thinks the FAT protocols thesis means, because I feel like it's also been kind of a moving target, and it's sort of the way that people explain the FAT protocols thesis sort of updates itself as people's perception of the space changes. So Lasse, I'm curious to you, what does the FAT protocols thesis mean?
Pretty much what I just described in the essence. And I think what I like about it, or what we like about it, is that most people try to sort of be the smartest in something. And we're actually trying to be in a situation where we can be pretty dumb and still sort of win. And what seems to be appealing, and actually Ethereum pitched this really from day one, is sort of this, if you invest in Ethereum, no matter what, if an insurance protocol wins on top, or something like Bitcoin, hard money, or, whatever it is, a decentralized exchange, there will be demand for the protocol underneath it, for the computing resource, which is gas, therefore some demand for ETH itself. And then, on top of it, probably sort of a speculative investment layer. And this is kind of the idea. And why we generally like this is because you can invest sort of more in an index, right? If I thought the internet is going to be big, but I don't know how, I could buy a lot of domain names. I think that was sort of one of the safest sort of index bets on the internet itself. And here it seems much easier to bet on sort of crypto, the internet value, these kind of things, by investing, like say Ethereum, and for portfolio sakes, a few other of those. I think that's sort of from the layer one, really almost at the bottom of in theory you have something like NIM, which is layer 0, kind of like really the lowest layer sort of protocol investing, and then potentially this goes further up the stack as well into some DeFi protocols.
Yeah, I think that's a really good point, right? Like there are different layers of the stack here. So in 2017 and 2018, a ton of kind of resources were dedicated to finding base layer protocols that could compete with Ethereum or Bitcoin. But there are other protocols such as, in the DeFi space with things like MakerDAO and Compound, which I would also argue are protocols as well, obviously. And I think the question of where does value accrue in the space is a really good one, and probably worthy of discussion with you guys. Because I think you can make the argument that just because a protocol has value doesn't mean it captures value well or captures a lot of value, right? It just needs some value in order to kind of operate in a Byzantine environment. What do you guys think about that? Do you specialize in certain areas or categories yourselves? I know mostly we're pretty agnostic here, but I'm curious about your kind of recent efforts.
So I would take a more general view of the word protocol investing. I mean, protocol in computer science is really just means it's an interface or a set of rules for different things to talk to each other, right? So like the English language is a protocol. I mean, driving on the right side of the road is a protocol, right? Like there's ways for different things to talk. Like protocol is a pretty general word. Computer science, it usually means you've got some formalized definitions of like, these, whenever you talk to this computer, you send over these packets in this order or whatever, right? In the case of crypto, we're operating, I think, a few levels higher, but really the protocols that we like to invest in are ones where you've got some supply, some base of people who can supply some service, some demand out in the world to accomplish some job. That job in most cases is commodity or commodity-esque, although not always. And you can, it was impossible to connect supply and demand. Maybe it was previously possible with some sort of intermediary in the middle, like Facebook or Uber or whatever. But in some cases, there's a really unique opportunity where you can connect supply and demand with a protocol where the protocol is almost acting as a public good of sorts. And that protocol can make these parties connect. And our favorite investments we've ever made have been ones where we've seen some sort of latent supply and latent demand, and identified that there's actually a cryptographic network protocol that can connect those in a novel way. And when you can do that, those are just kind of explosive new opportunities. So Bitcoin mining was the first one, but there's all kinds of other cool. DeFi's got its own kind of interesting world, and there's all kinds of other stuff like out there like Helium and LivePeer and Arweave and the Graph and these other things that are kind of servicing new types of markets.
Yeah, I kind of want to take back the word protocol a little bit because I feel like it's sort of become it's like the best way to kind of fluff up an application is to call it a protocol. And I think, in the very early days, actually when Joel Monegro originally wrote the Fat Protocols post, I think it was very much in following this tradition of Silicon Valley looking at Bitcoin and calling it a protocol. People today don't call Bitcoin a protocol anymore. Like, I mean, obviously it makes sense to say that, but we talk about Bitcoin as like, oh, it's digital gold, it's a form of money, it's a non-sovereign store of wealth. People don't throw around the word protocol anymore unless they're talking about Ethereum or smart contracts or file storage or one of these other things. And if you I think if you do a little bit of archaeology on how the way that we describe these different categories of things has evolved over time, I feel like the story is that protocols, going back, Kyle, you mentioned public goods, right? The internet is the stereotypical public good in that literally, the internet takes no value from what's being built on top of it. So all of the value is basically left to be captured by the applications, the businesses, whatever is actually happening on the substrate of the internet. And there's this, the original core of the idea of the Fat Protocols thesis was that that's what crypto networks were going to invert. Instead of having most of the value live on top of the substrate captures the value of the stuff being built on top of it. And that didn't happen for Bitcoin. There are a lot of things that use Bitcoin, but Bitcoin is capturing most of the value. Bitcoin is way bigger than Coinbase. It's way bigger than the exchanges. It's bigger than anything that has been built on top of it. And the question is like whether that's a generalizable property of all of these quote unquote protocols, or is it that Bitcoin's this other thing? Bitcoin is money. None of these other things are money. These other things are protocols. These other things are platforms. I kind of feel like a lot of the way that we decide what's money and what's a platform, there's this fight going on in the crypto world of whether ETH is money, right? And Spencer, I know you're hard on one side of that. But this is actually a really critical question of like, is ETH like Bitcoin, or is ETH like a platform? Is it more like the internet? And I think this is one of those things that the language that we use really kind of tells you which side of this divide that you're on.
Yes, I wholeheartedly agree. And the basis for the Fat Protocols thesis as it was written was incorrect for exactly the reason that you identified.
Well, I think
can you elaborate?
So I think it depends, right? So Bitcoin also, it's a terrible token. It's just a payment token, and now we sort of this meme has been invented that you hold on to it because it's going to be like a store of value, which could become a self-fulfilling prophecy, and I think it could be great. But other than that, it was just a payment token. You literally give it to the miner and they dump it because they need to pay electricity. It doesn't retain any value. And the same thing we've seen with Ethereum that has also been struggling to retain value relatively to, coming back to your question, Spencer, relative to I would say the activity and the momentum that is that is really happening on Ethereum. The value capture has been okay, has been fantastic, right? And I think that's because up until this point, also ETH is just pretty much a payment token. You pay the miners and they sell it for electricity. And then sort of capturing value really comes down to basics, supply and demand. Do you have a very genuine sort of organic, real, utility of the token? Does it have some function? And does that also happen to sort of, restrict the supply a lot while potentially you have a lot of demand, right? And I think with ETH2, it'll be very, very interesting to see, how much supply is actually removed from the market for staking, and how that will affect the value capture of Ethereum. And I think that's one of the biggest sort of and longest experiments of answering the question, like, do these things actually capture value beyond sort of Bitcoin having sort of its own thing going on? Does something like an internet of money, which Ethereum could be, is actually going to retain a lot of value or not? And I would say the way it currently operates as a payment token for miners, no, not really.
But so when you ask the question, does Ethereum capture value, right? Traditionally, if you look at like a supply chain for selling aluminum or something, right? What we mean when we say that we capture value is that somebody is commanding more than the commodity value of what they're providing in the value chain, right? So very often this happens because you're a monopolist, you're a bottleneck, whatever. So when we say that Ethereum is capturing value, that has to mean more than just the price of Ethereum is going up, right? To my mind, when we say Ethereum is capturing value, like the price of Ethereum went up like crazy in 2017, 2018. I don't think it captured almost any value. I think people were speculating on Ethereum like crazy, and it became this monetary premium because people were using it to buy ICOs. But capturing value means that the value that would be going to the protocol gets co-opted in rent by the protocol. Or sorry, the value that would go to the application, instead of the application developer being able to get a bunch of money, it gets taken away in rent, right? The way the App Store takes away money in rent. And right now, actually, we're seeing all-time highs in fees paid on Ethereum. That, to me, is the first sign that actually Ethereum is capturing value, because it's taking value from application developers, from users of the protocol, and paying it out to miners, right? That, to my mind, is like what traditionally we originally meant when we talked about value capture.
Okay, Spencer, we're gonna go down the like theoretical rabbit hole, like what is money? And, like,
I was gonna say, I think we should climb ourselves out of this.
Okay.
And maybe we can return to it later. But it is a topic that I do love, and I know you guys do too. But let's maybe address the core question here. Like, do you guys find that there are VC scale returns in protocol investing? And I think the answer is yes. So I guess my question is, why Ryan and the Masari crew, they're obviously very plugged into the crypto space. They've created an awesome panel with tons of people, and they're really just plugged in. Why are they asking this question, right? If it's so obvious to all of us, then why are some of the people who are in this space and are in it in a day-to-day basis, why do they still have concerns and uncertainty about protocol investing? And so I guess what I want to know from you guys is, how do you message that to your LPs, to your partners, to the people that you work with, about how you think this is a long-term investment, and yeah, how do you justify it?
I think there's basically two schools of thought in crypto. There's money crypto, which is Bitcoin, hard money, and the deviations of it, and then there's sort of technology crypto, right? And I would definitely fall that I think money crypto is interesting, but what we do with the fund is really is technology crypto. And for us, it's roughly that the cost of trust is roughly around 35% of GDP globally, is just the cost of establishing trust. From law enforcement, judges, auditors, administrators, managers to some extent. So trust is very, very expensive. And a lot of times it's just impossible to establish that. And now, because of the nature of open source systems or crypto networks, you have the chance of establishing trust in markets where it wasn't possible before, and potentially reducing the cost of trust almost down to zero, right? So think of cost of trust as like, why do we pay banks money? Mainly because it costs a lot of money to establish a brand that is trusted, right? And you have, what the Stratton, Oakmont, whatever did with the lion, and these kind of all these ad campaigns that you see, sort of very majestic things. Maybe if it's private banking, the sales guy needs to send his kids to the same private school as mine so that they start trusting him. We need to go to the same country club, right? So all these things are like in the intangible cost of trust, and trust. Then also that cost of trust applies to many, many different industries sort of across the world, almost universally to every aspect of commerce and society. And so so there's the money crypto sort of investment thesis around Bitcoin and the recent macro trader, who bought into that. And then there's sort of more institutional LPs who have been investing into venture capital funds that are now allocating to crypto venture capital funds, roughly around that thesis that, cost of trust is very, very high across many different industries, and we invest broadly in the technologies that over the next 5 to 10 years will, drastically sort of change markets and reduce cost of trust.
Yeah, so I think this question kind of ties to Ben. You asked a question a few minutes ago on like latent demand. Like, what does that mean? What are latent demands for different types of protocol services? I'll focus on this in the tech crypto, not the money crypto sense. So there are at least half a dozen, probably maybe a dozen or so, I think fundamentally different markets that have been identified that there is demonstrated some demand for using these things in kind of novel ways. So I'll highlight just a couple of them. One is helium, is probably the most unique, where if you think about a wireless network like Verizon or AT&T or whatever, like by definition that network has to be physically distributed, right? Like you literally need a bunch of towers all over the place. Turns out that for all kinds of interesting mechanical reasons and kind of the way like backhaul works and CapEx and whatever, that the only way to build a wireless network historically was to have a large company build and own and manage the entire infrastructure. It's extraordinarily capital intensive, requires tens of billions of dollars. That's why there's 3 or 4 telecom. Basically, every major country in the world has 3 or 4 telecoms. Like you can't sustain in any country more than a handful for kind of CapEx reasons. Turns out, like if you can come up with a way where you can empower people in their own homes to have a radio antenna, they plug into their Ethernet in their wall, they create radio waves, and if you can figure out a way where you can coordinate payments, where if a device is walking around and wants to use the antenna, right? Like if you can figure out how to coordinate the locations of these devices, which is kind of a hard problem, payments and a few other things, then you can actually have a wireless network physically distributed, but that is not owned by one company, or the network is coordinated by a blockchain effectively, some sort of neutral open database, and the network is owned literally by the people who have the hotspots, right? And so the largest investment we've actually ever made is in a company called Helium, which does precisely this. That's one example. There's a lot of others around data storage, so things like Arweave and Filecoin. There's things like the Graph and LivePeer. So there's all these kinds of interesting commodity or commodity-like services that exist out in the world that are still, I think, largely unrecognized as being able to connect supply and demand in new ways. And I think those are, if you look at basically any of those markets, it's just very quick that you get to like venture scale numbers, typically in the 10, if not 11 or 12 figures. And so those are probably our favorite investments.
Yeah, so Kyle, I think, was kind of looking at, how can crypto disrupt markets that we already know to be large. But I think the majority, if you sort of zoom out and you just look at what crypto investing looks like, it's like, oh, okay, we're investing in things that are kind of like Ethereum or sort of Ethereum competitors. That's most of what people think of when they think protocol investing. And it's certainly been kind of the marquee investments of the super mega funds that have made, gigantic rounds like Telegram and Hashgraph and all these things. So I think if if the kernel of that question feels to me like, well, is there enough substance there to justify a big market, to justify big valuations, and to justify big returns? I think the answer to some degree is that if you believe that Ethereum is basically a toy and it's worthless and it's not going to do anything, then I don't think I'm going to be able to convince you in a 20-second soundbite that it is and that it's going to go somewhere. I think already we've seen glimpses of what makes these blockchains so valuable. But it's also very clear that they're in their very, very early days. The technology is not fully fleshed out yet. And crypto is both a technological and a social revolution. And you kind of need both pieces to work in order for real innovation to take place. Right now, it's clear that Ethereum is in very far ahead in the lead. And so it's kind of like taking on Nokia in the cell phone industry, where they sort of seem like this behemoth that just owns everything. They have complete distribution. They have complete network effects. The thing that I like to remind myself is that it's still super early. We're in the very second inning of this thing. And it'll probably be longer than any of us think it's going to take until we get to the point where these systems are really mature and robust, and we actually sort of look back with hindsight and be like, oh, funny how that played out. I think we're still in the phase where people are calling the game in the very, very first quarter, and that's part of the reason why I think there's still lots of returns to be had.
Yeah, I definitely agree. And I think, if we just take like the money and base layer cryptos and just like put them off to the side for a second and just talk about some of the kind of layer 2 protocols, DeFi, other categories that are out there. I think it's becoming easier to justify a venture-like return kind of profile due to the fact that these are literally spitting off revenues, right? And we can see through either governance tokens or rev shares that if someone's using Synthetics Exchange, if you're an SNX holder, then you are making money based on that, right? 0.3% or whatever it is. And so you could begin to model these with kind of like traditional valuation methodologies, and you can value them like a regular kind of traditional company. And so I think that's absolutely something that we can look to in the future, just more companies like that, and maybe not so much the money kind of memes debates that we have to all get into. Although I do think, like you said, Asib, there's probably a lot of room there as well. So I'm curious for you guys as investors, when you're looking at investing in these layer 2 protocols, what do you look for? How do you value them? Are you using comps? Are you using other kind of methodologies? And what do you think the biggest risk factors are?
So I think, this is a lot of more, people who are in finance or more from the business side is sort of technology and venture capital. It's not private equity. You are not, plugging numbers to a spreadsheet, applying a DCF model here, and this is what this thing is worth. I think this will come, if ever it comes much later. At least to our mind, venture capital is in a way that you look at something that is a large market or potentially very, very large market that sort of seems to be clearly on a very, very big trend. And then you have a protocol, product, project, whatever, that really enables something that wasn't possible before, or just sort of radically expands the market, right? And this is why people of that thinking, a lot of them missed Uber because they calculated the size of the taxi market in San Francisco, said, this is exciting, etc., and completely missed out that actually Uber was that transformative. It just radically expanded the market. And so, we don't do cash flow, DCF models or anything like that. What we really look for is these incredible founders that are just so far ahead that we have, we can run next to them and throw them a bottle of water every once in a while if we can keep up. And they're working on something that is clearly going to be or potentially a huge market. Is ideally even something like a 0 to 1, right? So Arweave is really, really exciting like that. It's a lot of people had a really hard time or still don't really see it because Arweave, to our mind, is something that just wasn't possible before. And so, and those are actually really exciting because then, it's, what is this? Invest in things that haven't happened before, what never happened, right? So that could be really, really exciting, where you kind of have these in some form. That the demand is there. This is really a 0 to 1. This is something that wasn't possible before. Large market, fantastic founders. and that's it. No DCF models, even for DeFi protocols.
Yeah, I think Uniswap is another example, right? You have kind of this whole long tail of exchange pairs that you could never get sufficient liquidity before using centralized, kind of like a match, like a market making system where you're an order book, I should say. And now you introduce basically an algorithm that creates liquidity. And so I think this just kind of opens up a new market. And lastly, just like you said, to try to like quantify how big that market could be someday is basically a fool's errand. But we do know, we have this inkling that it's going to be really important.
So I think in venture, there's two kinds of companies. There are upstream companies and downstream companies. A downstream company is one where basically you're giving consumers things that they already want. And your job as an entrepreneur is basically to follow the needs of your customers. So this is like any kind of traditional YC company is like, just listen to your customers, give them exactly what you want, and then scale them up, right? Those companies are the kinds of companies where you measure a TAM, you do a DCF, you look at you look at the unit economics, and the companies that look like that in crypto, there are some, but they tend to be exchanges, they tend to be lending businesses, they tend to be sort of the more kind of brick and mortar picks and shovels type businesses that are really big in crypto. They're the biggest companies in crypto, I think, by some measures, are hardware companies. But the stuff that we primarily are talking about is protocol investing. That's more of an upstream company. An upstream company is like an Uber or an Airbnb, where you are trying to build something that doesn't yet exist and that people don't yet want, and they don't even know that they want. And when you're building an upstream company, it's, TAM calculations are just, kind of throw it out the window. Like, it's all kind of very hand wavy. Unit economics, who the fuck knows? Sorry, my allowed to curse. And there, all the ways in which you traditionally estimate, what do people want? How much buying capacity is there for this thing? You're betting on change. You're betting on the world transforming around you. And that's intrinsically hard. Most of the people who bet on Airbnb early on had no idea what the size of the market was going to be and how large a company that did this thing could become, because Airbnb worked by changing the way that people behaved. And in the same way, crypto is going to live or die on the basis of, can it change the way that people think about money and the way that people think about finance and ownership and all these things. So I think for that reason, you can kind of see, if you sort of zoom, if you sort of what's the word? I guess zoom out far enough and kind of loosen your vision, then you can get a sense of like, okay, I think this could be really big. How big? I don't know. Anything that I put out there is really an order of magnitude guess.
Yeah, Kyle, this is a question for you. We're going to change topics here because I wanted to touch on basically a case study in protocol investing and get your take on it. So, I mean, we talked about the exchange space, right? You have a company like Binance, you have, Coinbase or Uniswap. This kind of like goes across the entire spectrum of a protocol all the way to like a hyper centralized company. Where do you think value and the winners accrue in the space in the future?
So using the example of Coinbase being the most centralized, Binance being a middle-y thing, and then Uniswap being pretty decentralized, if not really close to the far extreme, there's some value to be had in all three for now, for sure. That's actually empirically just true. I mean, the question is, on what time horizons do the relative value shift, let's say, for the specific problem of trading assets? Our bet is that it's going to move mostly, at least over the next 5 years or so, towards the middle. We've been pretty clear about that bet. So like the exchanges are just generally in our view, the most interesting area in crypto. They have scale, they are big businesses, they have a lot of people. The thing that people want to do is trade. There's now staking and lending and like weird derivatives and like all these weird things happening on the tangent, right, of exchanges. So our bet is that like if you can insert a token into that business model in some way, you can figure out a way to like incorporate all these things together in some kind of funny mishmash way. Binance kicked off that trend. I'd say they've done an okay job of evolving how that value can kind of capture into this token thing. They haven't done a great job. I don't think anyone's done a great job at that yet, that launched as a centralized exchange. But you can see all of these guys moving kind of in that direction. The challenge for the decentralized exchanges is just like performance for trading. Today, if you look at trading in crypto, the stuff that happens across the major centralized venues is on the order of about 100x the volume that happens on the decentralized venues. There are all kinds of reasons for that, but it's about 100x or so. And then if you look at like crypto versus traditional market, that's about another 100x in liquidity. So decentralized infrastructure today to do this just does not exist in really any meaningful way. Uniswap is cool, but like it just is never going to do what that requires to operate at global scale capital markets. So I think over time you will see value shift towards the decentralized end of the spectrum. It's very unclear if you'll ever be able to get rid of 100% of components of centralization, given the need to bridge to fiat. But again, look, if your time horizon goes long enough, like sure, we all have Libra or central bank currencies or whatever, but like that seems a little out of scope. But for now, it's moving towards that direction, and we made a pretty big bet on the middle. Luckily, it's also liquid in the middle, and so you can kind of readjust where you're aiming over time.
The one note of caution I'd give you, Kyle, is that the one thing about technology is that it always gets better. It never gets worse. And so I think there were a lot of people in 2005 that were claiming some things will just never be on the internet because people are always going to want to go into a store, or they'll always want to, smack around a car before they buy it or whatever. And increasingly, as people find better and better substitutes, that's the thing with respect to DeFi, I totally agree with you. It's not there. It's nowhere near being there. But if the only thing in your way is technology, I wouldn't bet against it in the long run.
Oh yeah, I'm all for decentralized. I think it's going to grow humongously over the next few years. If the time horizon is 5 years, I think centralized exchanges will definitely still be around.
Sure.
If the time horizon is 15 years, yeah, I'm more open to the bet that those things won't be around anymore. So just a function of time horizon.
Yeah, so I think it's definitely the longer game. I think these decentralized protocols are just playing a longer game, and they're going honestly for a bigger pie or to become bigger, because essentially what you're doing with centralized elements, you're always extracting value out of this ecosystem, right? And you sort of selectively might be reinvesting something, but you're taking a large part of the value out to your shareholders. You might throw your token holders a few breadcrumbs here and there to keep them happy, but essentially there's a small number of people that are extracting a lot of value out of these centralized exchanges. Whereas with these protocols, you really, it's ingrained in the protocol that you're constantly reinvesting. If you're taking any value or distributing it, you're really actually immediately distributing it among the most valuable contributors, stakeholders of your ecosystem, right? So you're constantly reinvesting. So it's basically Jeff Bezos, your margin is my opportunity, hard-coded into the protocol, until the very end. So I think it's definitely a long game. And I would agree that, we clearly seeing this, that decentralized exchanges are sort of, accruing or extracting value on a much, much bigger scale. I think it's just really, it's the time horizon, over the long period. I think the simple theory just sort of dictates that, yes, actually these sort of protocols will actually ultimately always win, because they're constantly reinvesting into the ecosystem. And to the volume part, so I would say, as a metric, so 60% of volume is fake, right? So take 30, 40, 40% of volume. On top of that, most volume actually itself isn't volume because there are people trading. Most of the volume is just to provide liquidity for when that one time this person come in, wants to trade $5 million, they can be accommodated, right? So even if there's real volume, most of it is market makers. And so a lot of the requirements for high frequency trading, where you say DEXs, they don't scale, they're too slow, they can't accommodate high frequency traders. Well, why do you actually need them? They're not an end to itself. They're mostly there to provide liquidities for the people that actually want to trade. So I would also say that if you take away all these things and you think actually slippage and liquidity is really the main thing, you are and you don't actually need most of that volume that you have, because that actually just serves to have slow slippage and liquidity, then I think we're getting quite close. And I saw, I think almost a year ago, from I think it was DeFi Dude, someone on Twitter just made a video of trading, two windows. One was on Binance and the other one was on Kyber. And it was just mind blowing how much better Kyber was, because it's MetaMask, picks the price, the asset, 15 seconds, done. And there with Binance, log in, 2FA, deposits and the tokens there, wait for 30 confirmations, trade, withdraw, 2FA, email confirmation, right? And the whole thing took 15 minutes versus like 30 seconds. So I think we're actually already there. Of course, it's not, if you're a hedge fund and you want to, do a $50 million trade instantly like this, the liquidity isn't there in DeFi yet.
Yeah, I think so. I made a similar point on Twitter the other day, and Coinbase, a bunch of employees shot me back and said, "Yeah, well, there's no, customer service from your DEX, which is obviously a really big thing." So I think it's a really good debate. But lastly, I want to talk about something that you mentioned, which is the fact that these decentralized protocols basically allow their communities to own and operate them. But Kyle, like with something like Binance, that isn't really the case, right? They have this token and it's being burned, and that's really it. Do protocols need to have this community ownership and operation and governance in order to be successful, or can we see just kind of pure revenue shares work?
Well, it depends. If it's a large network with many different stakeholders, suppliers, users, etc., then we think so. Yes. If I don't need to tokenize my supermarket around the corner, really. But if you have very, very large network with many different stakeholders, actors, with many different sort of incentives that could be opposing, I think you do have a much better chance at designing an incentive flow that sort of aligns all of these different actors together than if it's a company which ultimately if you extrapolate it, so every company that we've seen in the Valley in the last 20 years, they have big-eyed founders, they want to make the world a better place, etc., but then you do own with a versus customer dynamic. This is I think Charlie said, show me the incentives and I'll show you the outcome, and the incentive at the end of the day is to create a natural monopoly, right? This is Peter Thiel playbook. Create a natural monopoly, and then as much value as you can because pretty much you can. And so our take is that if you actually have a large sort of network, and you are able to effectively distribute the ownership and the governance to, let's say, the most valuable members, which is incredibly hard, and we're all kind of working on trying to figure out the best way to do that. At least our that over the long run, you will create some networks that are potentially more valuable than any other company, because you won't hit that dead end. You're just basically, exploiting your suppliers and your customers to the maximum.
So I would argue that if you look at, oh, sorry, Kyle, go ahead.
So I think Uniswap is a very instructive example for this question of, do you need to govern these things? Let's not go talk about layer ones, because layer ones are their own kind of weird thing. Let's talk about some smart contract living on the layer one. Uniswap is good, and it's actually right now about to go through a fantastic case study over the next 6 to 12 months. So like the simplistic vision of this is pretty simple, which is no, it's a public good, and like you don't need to extract. It should, in fact, it's a protocol, and protocol should be neutral, and it should not extract any fees it doesn't need to. Something like Maker is interesting because there's risk in the system, so that's kind of a separate question. But in Uniswap, in a very simplistic version of the system, you can justify, at least on the surface, like there should be no fees that are going to some token holder somewhere. The counter is that you can do something like liquidity mining, where basically you can say like, look, if you trade against the system, you get some Uniswap tokens, or if you provide liquidity, you get some Uniswap tokens or whatever. And we're seeing this battle is like launching like right now between Balancer and Uniswap and Mstable and Curve, and a bunch of people are doing Future Swap, or they're all kind of doing variations of the same general thing. And so the really interesting thing to see here is they're all saying this tokens for governance, which like, yeah, sure, there will be some things to tweak over time or whatever. But then obviously the real reason people care is because they expect some sort of fee somewhere, right? And that fee is coming out of someone else's pocket. And so I think the really interesting question is going to be is that when all this liquidity mining is over, which may take 12 or 24 months, we'll see how long these things are going to go for. At that point, like if you're an LP in Uniswap, let's say, you've gotten all of your free tokens effectively. At that point, like if you just sell your tokens, fork Uniswap, and create a new thing, like, and the liquidity aggregators point to your other, fork through Uniswap, then like, can you be a free rider and have just benefited from this liquidity mining thing, and then also just like not pay a tax to someone else later? And so it's going to be a really interesting game theory to see how these things play out over time. They're super interesting. It's not clear they need to be governed in a formal way. It's not clear that you need to tie those to cash flows. It's not clear that the state of those networks is meaningful, that you can't fork them, especially when the demand side that's going to flow into those things is going to be aggregated and is going to be hunting for the best price. So I think the really key thing that's unique there is liquidity aggregation. People who go to uniswap.com or whatever, like, okay, they'll go to the main one. But like, if you just go to 1inch or DexAg or whatever, like those people don't care where it comes from. Like they are pure mercenaries. And the pure mercenaries will not be loyal. And so it'll be really interesting to see like what happens is kind of where you aggregate demand in these systems. But I think it's going to be a lot trickier than people think.
What I think is most striking about governance is just how little we have actually learned in the last few years about what works and what doesn't. It feels like people seem very confident that we've learned a lot and that we're now like farther along than we were 2 years ago. It doesn't really feel to me like we are. It feels like almost every token model, no matter how much, it seems that what we have improved at, what we have genuinely broken new ground on, is the formalization of governance. So there's now a lot more formalisms around governance, which is an improvement, right? In some sense, if you like that kind of thing, then it's an improvement. But I don't think we've actually done very much to decentralize governance. So, you know, as an investor, I mean, we're all investors in protocols. Many of them have tokens that are engaged in governance. So we've all participated in the governance of these protocols. And I don't think, you know, if you guys are being honest, like how different was it post-governance to how it was before, you know, formal governance, in that basically there's a small set of insiders who are basically making decisions and nobody else really knows what to do. Nobody else cares. Nobody else has any reason to doubt what the insiders want to do. And so effectively it's like, okay, there's these formal procedures, but it's sort of like, you know, it's sort of like one of these Silicon Valley tech companies where the founder basically owns everything. And if they don't own everything, well, they sort of lean a little bit on it and then everybody kind of follows them. So I think all these things are not really at the stage yet where we can really have that, we can really have an honest conversation about like what worked and what didn't. Because it doesn't really feel like we have any good examples yet of what's worked and what hasn't.
Yeah, I think that's a great point. Kyle, do you want to get your last comment in? Then unfortunately we have
we have at least one example of what doesn't work.
What's that?
We have one example of what doesn't work. EOS did not work.
Yeah, that's true. That's true. That was your horse. Remember that?
We were wrong. We got out. We're
right,
happily forgotten about that one.
Right.
Okay. Well, I never will.
Yeah.
All right, guys. Well, this was a lot of fun. It was great going down the crypto rabbit hole with you guys a bit on this topic of protocols. We've got a jet, but thanks for joining me.
Thank you.
Thanks for having
Thanks
us.
everyone. Bye-bye.
Great.